Stock buybacks are Warren Buffett's favorite way to boost a stock's price. When you're sitting on a massive pile of cash and don't know what to do, buy back your own shares and ride the wave up. GM is just one example of a company that poured money into share repurchases and could have easily used that on more productive purposes. But of course, creating a healthy and strong company is not the goal. It's appealing to the shareholders within the current quarter, always taking a very short-sighted view, which will always end in disaster. You came here for the truth, so let me unveil that for you. Today, we're going to look at share buybacks. We're going to look at GM. I'm going to show you what's happening today. So let's begin by taking a look at this. Betting on themselves. Share buybacks hit a record high in the third quarter of 2018. I showed you that this would be the case for 2018. It was widely expected that it would be over $1 trillion worth of buybacks. So of course, at the end of the year, we'll total that all up and I will show it to you. Corporations' appetite for buying back their own stock has hit a record high. Stock buybacks by companies in the S&P 500 climbed to $194 billion in the third quarter alone. That shows us that they have one real goal, and that is to keep the stock prices elevated. They're sitting on billions upon billions of dollars that could be put to good use, but instead are used to purchase back their shares. I know that this is always the case, that there would be instances where that could be beneficial, but it's been happening quarter after quarter after quarter in such huge amounts. I have to start questioning it. It's not a small portion of the amount of money that they have. They have a lot of money and they're doing a lot of repurchases. Something fishy is truly going on if you believe that the market is strong, that the companies are strong. Something's not right. Apple spent more than $80 billion on share buybacks through the first 3 quarters of this year. There's a lot of other details in here in this Financial Post article, but I wanted to move on to take a look at one very good example. Warren Buffett, Berkshire Hathaway, buying back their own shares, $1 billion worth, and that is one very good prime example of how massive these can be in a relatively short period of time. GM blew $13.9 billion on share buybacks. This is showing us since 2014 what they had done, and of course it's been just quarter after quarter, it seems, of share buybacks. This is one company that has been under fire recently because they said that they're going to fire 15% of their staff. They're going to be closing down factories. It's obviously not good for anyone who has to work at these companies or, of course, within those cities that are heavily dominated by the car industry. During this 4-year period in which GM blew, wasted, and annihilated nearly $14 billion on share buybacks, the price of its shares, including today's 5.5% surge, getting rid of workers is always good news for shares, fell 10%. But don't worry, all of those expenses incurred during this restructuring will be, quote, adjusted out of the non-GAAP metrics that Wall Street touts. I'll continue on in just a second, but to talk about GM, they spent $14 billion during this period of time, and in fact their stock is worth so much less today. So what good did it do to spend all of those billions on these share repurchases instead of investing in the company and figuring out a way to use $14 billion worth to magnify their profits? No, they used it on this very, very wasteful, in my opinion, strategy, and in the end, people are out of jobs. That's what it comes down to. GM reassured us in the statement that these costs will be adjusted out of the EBIT, I love this, earnings before interest and taxes, adjusted EPS, earnings per share, and its automotive free cash flow. But the cost savings from reduced salary expenses, etc. will be fully represented in all metrics in all their glory. Wall Street's accounting magic wins again. And Wolf Street said it right. This time they are showing us exactly what's happening very relevant information because GM could have done something with that money that would have been productive, and unfortunately they didn't, and this is the result. This is why I've always been warning about the share buybacks and why it isn't good to see them at this level. As I said, once again, that there could be a time and a place where it makes sense. However, today, in what they're doing at these record levels, it's not good, and it should be a warning sign to all. This shows us that GM bought back $10 billion in stock since 2015, double what the job cuts will save. So they make a very good point right here out of CBS that when General Motors announced it was cutting up to 14,000 jobs and idling 5 automotive plants, it justified the massive cuts by citing long-term savings. The cuts would free up $6 billion in cash for a net savings of $4.5 billion in cash by 2020. That's how they projected to the media. The stock rose by over 5% as a result. But it's hiding the truth, and that's what I'm talking about today. Share repurchase shenanigans are not, however, confined to the dinosaurs of yesteryear. A recent Financial Times article outlined how the 5 tech companies with the most cash, Alphabet, Apple, Google, Cisco, Microsoft, and Oracle, repurchased an astounding $115 billion of stock in the first 3 quarters of 2018. By contrast, the total capital spending of the 5 companies was only $42 billion during the same period. We could see what has happened here with these companies taking advantage of this opportunity right now. They are purchasing back billions upon billions of dollars of their own stocks, and this has been very, very positive to their shares. There's no doubt about that. That's the whole reason you do it, is to push the share prices up, and the insiders are able to know when that's going to happen, and they sell off in times like this. That has been documented. I've done multiple videos of that. There's no doubt about it. So it gets into further detail here, but I just wanted to move on to get into this. China's new share buyback rules have investors worried. So this comes at a time when we're seeing all the other buybacks in the United States being very beneficial, being supportive to the markets. Take a look at this. Listed mainland companies who have bought back shares to bolster prices must wait 6 months before reselling, according to new guidelines as authorities continue to seek ways to shore up market confidence. Under the new rules published late last week by China's 2 main stock exchanges, publicly traded firms will be able to raise funds from bond issuance or bond loans to fund their buyback plans. It's going to get into greater detail here if you wanted to read about it, but I just wanted to show you this. China is doing things a little differently. Perhaps their rules are more stringent in some areas and relaxed in other areas. Okay, so this basically gets into the details. If you want to know about China and what's happening, you can pause the video, read that for yourself, or I will have a link in the description as always. Then we get into this. One of the biggest issues today that presents us with a cautionary tale is the tariffs, is the tensions between China and the US. These are 2 very big partners, and what happens between the 2 of them is always going to be a cause for concern for these markets. There is the threat of additional tariffs being added to Chinese products, which includes phones, laptops, and other devices that are not affected right now as it stands. That's going to have a major impact on companies like Apple, who is really at the forefront of all of this. There's a lot of details in this Bloomberg article if you want to read it. I just want to show you this chart. You can see at the very top of the list, cell phones here. We're talking about $45 billion worth, as well as laptops, which appears to be about $37 billion worth, so a significant amount. And I'm sure that companies like Apple are not going to be happy about this. If it does get implemented, maybe they'll get a pass, maybe they'll get a waiver, who knows, but still shows us that the tensions are increasing rather than decreasing. There's going to be a meeting soon, and there always seems to be one, where things are going to be resolved, so have no fear. This is not going to end well if we continuously see tensions increasing. It's only getting worse. That's having a major impact on what's going on in China today. That, of course, is spilling out into the other markets around the world. So I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. Last but not least, if you want the financial education you were not taught in school, these 2 books have it all. well. Everything from the foundation to the history to the asset classes, how to make money, tax incentives, and so on are all covered by these two books. They fit into each other like puzzle pieces. So I get into the major details that you need to know to be able to manage your own money, to be able to protect yourself and your family. So check them out at the link in the description. If you're more interested in the audiobook version, you can get that at themoneygps.com. If you're still here, just wanted to show you that the markets right now are roaring. They're roaring higher. The Dow Jones exceeded 25,460 points higher as I record this video in the middle of the day. And why? Because the Fed may not increase interest rates any further. What does that tell you about the fragility of this market? That this market is solely relying on the Federal Reserve and not continuing their quantitative tightening plan. Should be an interesting future.